Ladies and gentlemen, welcome back to your stock market update for January 16th, 2025. We had some economic data this morning with the Philly Fed, manufacturing data, initial jobless claims, retail sales, and more. We got a bombshell speech from Fed Waller today on CNBC that was just like so far out of consensus from what we've been hearing from the Fed. I'm going to share that with you and why I think Fed Waller is correct in his opinions. Now, on top of that, we have Scott Bessent that is doing his Senate hearings, and we're getting some headlines coming in there. Things sound pretty good so far, and that seems to be a positive for markets. Finally, we will take a look at the AI investor sentiment survey that just plummeted. I mean, only 25% of investors are actually bullish right now. This is your signal to be buying the crap out of our markets, because I have a pretty strong feeling, not financial advice, that we are selling the rumor of Trump's negative, policies, and we're probably going to actually buy the news after inauguration on January 20th. And I'll discuss that with you here in this video. And then last but not least, we will take a look at what Tom Lee just said about markets. Ladies and gentlemen, this is your stock market update for January 16th. If you are an investor in our markets, hit that like button. Let me know how many of you guys are actively involved in our markets, and let's get started. So first things first, I do want to start with the commentary from the Fed today, because holy moly, Fed Waller dropped bombshells. Fed Waller says, I don't think tariffs will have a significant impact on inflation. What the hell? I wouldn't even think that was a Fed comment, considering the Fed recently has over and over again stated, since December 18th at least, that they're going to take into consideration inflationary tariff pressures into their policy decisions. Fed Waller's saying, wait, I don't think tariffs will have a significant impact on inflation. That in and of itself is out of consensus right now. Fed Waller says the U.S. labor market is solid, not booming. Fed Waller says some of the strong jobs reports in December was a makeup from weak earlier reads. He says, this is the true bombshell, 3 or 4 cuts could be possible this year if the data cooperates. Wow. Wall Street is currently pricing in about 1.5 cuts for this entire year, following the data that we got this week, the jobs report last Friday, as well as the PPI and the CPI report in the last couple of days. He says, I don't think March can be ruled out for a rate cut. So potentially even looking at a March cut. Right now, the markets are not expecting the first cut until about June. So March, April, May, June. So that's 3-ish months faster than Wall Street is currently expecting. Fed Waller says we could start rate cuts several months from now if current expectations about inflation are met. Fed Waller says 6 of the last 8 months of inflation have been close to target. It's reasonable to think that will continue. Fed Waller says if there's a surprise like last year, the Fed will have to stay on hold, but I'm optimistic disinflation continues. And then Fed Waller says if numbers continue like this, it is reasonable to think rate cuts could come in the first half of the year. He says that inflation data for December was very good, and he says it looks like inflation is getting back to trend. I hope it continues. So this whole speech from Waller today was far out of consensus. And there's a lot of people that think that Fed Waller could be setting up for a shot at the Fed chair position by being more dovish right now. By 18 months from now or so, when Jerome Powell's essentially term is over with, Waller could be the guy that steps up. And you already know Trump doesn't want a hawkish Chair Powell, a new Chair Powell, right? He doesn't want someone that wants to keep rates higher for longer. So take that into consideration as well. Now, if we take a look at the economic data that came out today, it came in kind of Goldilocks, to say the least. Retail sales month over month came in at 0.4% positive versus expectations of 0.6%. So retail sales came in a little bit weaker than expected, which, is kind of Goldilocks. Things are still doing good, but they're not, explosively good. The economy's not overheating. Last month's retail sales were revised up from 0.7% up to 0.8%. And again, that's good, but not overly hot as well. Export prices month over month came in at 0.3%. Import prices month over month came in at 0.1%. Both of those beating estimates a little bit. Initial jobless claims came in a little bit on the higher side at 217,000 versus last week at 203,000 and expectations of 210,000. Now, Philadelphia Fed Manufacturing Index skyrocketed. We were expecting -5. Last month was -10.9. We came in at +44.3. That's insane. Business conditions came in at 46.3. I mean, that's higher than we've been in a long time. Last month was 33.8. CapEx index came in at 39.0. Last month we were at 22.2. Philly Fed employment came in at 11.9. Last month we were at 4.8. New orders really skyrocketed here to 42.9. Last month we were at -3.6. Wow. Prices paid also went higher. This is the inflationary component of the Philly Fed data. Came in at 31.90 versus last month at 26.60. But compared to some of these other numbers, Philly Fed prices paid really wasn't a big problem today, I would say. Business inventories month over month came in at 0.1%. That's in line with estimates. And last month was at 0%. NAHB Housing Market Index came in at 47 versus consensus at 45. Now, we do have some data coming out from China later on tonight at 9 p.m. We will get their GDP growth rate year over year, industrial production year over year, and retail sales year over year, as well as GDP growth rate quarter over quarter and fixed asset investment. So if these numbers come in weaker or better than expected, that could affect our markets to some degree. I wouldn't count on it. Tomorrow we have building permits and housing starts, but that's pretty much it. You have industrial production and capacity utilization, manufacturing production month over month and year over year. But really, the important data is out of the way today. Now, we will be getting a new GDP update at some point today. That has not come out yet. It says the next GDP Now update is Thursday, January 16th, which is today. The last update we had was 2.7%. So when we get that update, I will be sure to bring that to you. Now, TSMC had good earnings today and really gave an upbeat forecast as well, which is a good sign for the AI trade. It says here, TSMC net profit hits a record high as fourth quarter results top expectations on robust AI chip demand. TSMC's revenue in December quarter rose 38.8% from a year earlier. Net income rose 57%. So that's good. It says here, quote, even after more than tripling in 2024, we forecast our revenue from AI accelerators to double in 2025 as a strong surge in AI-related demand continues as a key enabler of AI applications. So, there's apparently nothing to be concerned with from the AI trade. That's basically what TSMC earnings said today. Now, with all of this data coming out today, and really over the past couple of days, you can see bond yields today are retreating yet again, down about 3.5 basis points to 4.61%. That is allowing the markets at least to hold up. The Russell is up 0.1%. Same for the S&P and the Dow, roughly up the same. The Nasdaq's down 1/3 of 1%. The VIX is down almost 2% today to 15.84. Now, I think there's a bit of consolidation that's happening following some of the boost up we've seen in the past couple of days. Now, let me show you this. Okay, this is by far the best signal you could possibly get to go out and buy the dip if you have not done so already. This is the AI Investor Sentiment Survey. Only 25.4% of investors are bullish as of yesterday. 34.0% are neutral, and 40.6% are bearish. This is a 1-year bearish high. So, think about August 5th, 2024, where we had the yen carry trade blow up. Nasdaq was down 6+% to open the start of that trading day. We almost hit a circuit breaker. We ended up falling 10% on the S&P. You're more bearish now. Fears are higher now than they were then. Okay, that's why I think we're going to get a buy the news kind of situation around January 20th. Wall Street's just way too bearish right now. Like, we're expecting something really, really bad to come. In fact, we have fallen over 50% from our 1-year bullish high. Our 1-year bullish high was 52.7%. Again, today we're at 25.4%. We've fallen over 50% from that 1-year bullish high. And virtually never do you get this low. This is like COVID crash lows. Okay. That's insane. The last time you were this low, let's see if we can actually pull it up. Or if it's going to be, oh, it's in Excel. Yeah, I don't have Excel on this computer. That's unfortunate. But it has been a very long time since bearish investors have been this high. And whenever you get to this level, you gotta just swallow your pride. Forget anything forget the bear thesis. Forget the reason why you're bearish. You just gotta go out and start shopping. That is essentially the moment that we're at right now. Now, if we take a look today, percent of stocks trading above their 50-day moving average at about 38%. I'm going to round up here. Still 2%, almost 63% of stocks are in an active decline below their 50-day moving average. Again, anytime markets are this bearish, you also want to go out and buy the dip. Mark Newton with Fundstrat also makes a pretty good point today. He says China crash is something few are talking about, and exporting deflation is something that will directly offset the consensus narrative of Trump tariffs being inflationary. So China could actually have a very deflationary effect on the globe, and nobody's talking about that. And honestly, I think that's a good point. I think we probably should talk about that. Take a listen to what Tom Lee just said about our markets.
Better than expected December CPI print. My next guest says this morning's report could be a good sign for the months to come. Joining me now with his market outlook and his best stock ideas for this month is Fundstrat Global Advisors Tom Lee, a CNBC contributor. Welcome back.
Great to see you, Scott.
All right, first, your view right now on this market is what?
I think that markets are showing some relief that CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI. So it's setting the stage for yields which kind of were close to touching 5% to kind of cool. And at a time when sentiment's been negative, I think we should be rallying.
Is the Fed back in the game? Which means this report was good enough, these two reports, really, as some are saying that, okay, you're not going to get a cut in January, but you could get one in March, and some people had written cuts off for many, many months.
Yes. Into this CPI print, the whisper number for core CPI was over 0.3, so the market was bracing for a really hot number, and you could see it in the Fed Fund futures where, as of yesterday, there was a 30% plus chance of a Fed hike. I think those sort of extreme views have been quelled, and I just think generally, without accounting for the fact that the California fires could mess with inflation, the inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay. How optimistic are you for the type of return we could do this year after back-to-back, 20+% gains for the S&P?
We've gotten some good harbingers so far because the first 5 days of this year, the S&P is positive. So I'd say there's an 80% chance of something over double digits for the year. And what's going to matter to a lot of people is how we do for the month of January. But as of January 15th, we're up 0.7%. So those are good harbingers for the year.
Can we have a good year if the Fed doesn't cut until later in the year and bond yields remain elevated for a while?
If bond yields get stuck here, it is a severe tightening of financial conditions, and I think it's going to hit housing, and we're already seeing it now. So I think it is important for yields to move directionally lower.
That's a long way of saying stocks will not be good if bond yields stay where they are now?
Yes, it's going to test the market's resolve. I don't think it kills equities, but it's hard for someone to be pounding the table if they think yields are going to be stuck at close to 5% for the next 6 months.
Wow, so if yields, let's just say they stay near where they are now, you wouldn't be as optimistic as you are?
I think it's going to raise concerns there's a policy error from the Fed, that either financial conditions are too tight or the bears will argue the Fed made a mistake cutting too aggressively last year.
Isn't this the base case? I mean, you have what is arguably a more inflationary environment because of some of the policies that are being talked about by a new administration. Sure, they may stimulate more economic growth, but with that potentially comes more sticky inflation too.
Well, there isn't necessarily a connection between growing faster and more inflation. There is some inflation that can be generated by tariffs, and that's the uncertainty.
But that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation. It's the reinflation trade based on some of the expected policies that may cause that.
True, but to keep in mind, last year's inflation, first of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. So I'd say that it's difficult for me to make the case inflation's getting strong.
Now, also, I think worth mentioning from a technical perspective, the S&P was in between the 20-day moving average and the 50-day moving average. This is the SPY, so technically the ETF. You were between that yesterday. I said in the last video, we were either going to break out to the upside of this or break down to the downside. It looks like we're breaking out to the upside. Take a look at this purple line here. You're holding support at that level right now. As long as we hold support at that level, it's likely going to be hold support. And if we can break above this trend line here, which is about 596 or so, we could be soon making our way to new all-time highs. Now, I do believe at that point, when we break out to new all-time highs, it's going to be more of a broad-based rally. It's not just going to be one sector. It's going to be broader participation in our markets, and that's my expectation. Now, I think this likely starts after January 20th, but hey, that's just my personal opinion. Let me know what you guys think about this information down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.